Section 1, Crypto's Third Miracle, Prediction Markets as Policy-Grade Intelligence. A Flint West monologue. Here is where we are. The Federal Reserve just cut rates. Again, third cut of 2025, another 25 basis points shaved off the overnight rate, in a world where inflation still has not politely sat back down in its 2% chair. They call it data dependent. We call it playing chicken with the bond market using other people's purchasing power. Now, important reminder, the Federal Reserve does not control interest rates. The Federal Reserve controls one rate, the overnight rate. The short end, the tip of the yield curve spear. The long end belongs to the bondholders, and the bondholders are not a polite advisory panel. They are the final court of appeal, the Supreme Court of Capital. They are sitting on a pile of sovereign IOUs big enough to bend gravity itself, and they have exactly one language they speak: yield. If they do not like what policymakers are doing, they do not write op-eds. They do not subtweet. They simply demand higher compensation. And the 10-year, the 20-year, the 30-year drift higher like eyebrows raising in slow motion. You want to cheapen future dollars while flooding the system with stimulus? Fine. Pay more. That is what is happening, not just in the United States, but globally. Japan, running the classic playbook of insisting everything is fine, lines up a fat stimulus package, roughly $120 billion worth of reassurance. Bondholders see that and say, oh, wonderful, more money chasing the same amount of goods. And suddenly the 10-year, 20-year, and 30-year bond yields start climbing like they heard the fire alarm before everyone else. Europe shows similar mood music. Government maneuvers in France and Germany that smell like more spending, more debt, and more pressure on future purchasing power. And the long end starts grumbling. The United Kingdom is the one student in the classroom who, for the moment, raised their hand at the right time and said something the bond market found acceptable. You can almost hear the gilt saying, "We approve for now, but do not get clever." So zoom back out. Central banks are cutting or preparing to stimulate. Inflation is not convincingly gone. Bondholders do not want to be the ones holding melting ice cubes 10 years from now. That is the backdrop. Now, here is where it gets interesting, and where crypto walks back into the frame, like the character the writers tried to kill off in Season 1, but who returned with better hair and a stronger story arc. Section 2. Miracle 1. Bitcoin, the uncomfortable truth. It started with Bitcoin. They laughed at it. They banned it. They called it a toy, a scam, a bubble, a tulip reenactment. And then slowly, painfully, the traditional system realized something uncomfortable. This thing does not go away. People who did not want to buy gold, did not trust banks, or did not like the idea of their savings being one emergency decree away from being frozen for their safety, found something that does not require permission, does not shut down on weekends, does not care who the president is, and is extremely hard to confiscate at scale. Bitcoin became the first miracle, a censorship-resistant, globally accessible store of value that resonates with the next generation far more than a bar of metal or a bank brochure. Traditional finance disliked that. Right up until clients demanded access, competitors began offering Bitcoin products, and the game theory rolled downhill. Now we have exchange-traded funds, public companies with Bitcoin on the balance sheet, and central bankers learning how to pronounce Satoshi. Reluctant adoption is still adoption. Section 3. Miracle 2. Stablecoins, weaponized convenience. Then came the second miracle, stablecoins. Regulators first saw them as an irritation, as funny internet dollars that might interfere with domestic banking channels. But then someone in the policy hierarchy did the math. Hold on, so you're telling us we can have round-the-clock dollar rails, instant cross-border payments, programmable money, and all of it backed by our own treasury securities? So we get demand for our debt, global usage of our unit of account, and a vast private distribution network for the dollar? Stablecoins shifted from being seen as a shadow banking threat to becoming a strategic asset for maintaining United States monetary influence. Dollar-backed stablecoins became eurodollars with an upgraded interface. The same geopolitical function, now in people's phones, in decentralized finance, in remittances, in gaming, and in trade. Crypto earned its second feather in the cap. We improved the existing monetary system. Section 4, Miracle 3, Prediction Markets. the policy oracle. Now we reach the third miracle, prediction markets. Platforms like Polymarket and Kalshi are evolving from niche betting venues into sentiment oracles used by serious market participants. They provide a real-time probability map of how the world expects major decisions to unfold. Look at the most recent Federal Reserve cut. In the days and hours leading into the decision, Polymarket's odds steadily shifted toward a 25 basis point cut. That is not superstition. That is capital placing bets on how one of the most powerful institutions on earth will move. And here is the subtle part. Even though the United States government initially tried to suppress prediction markets, calling them gambling or attempting to restrict access, the signal refused to die. Traders showed up, liquidity deepened, the odds sharpened, and analysts, journalists, traders, and yes, almost certainly staffers inside policy institutions began paying attention. Because if you are data dependent, why would you ignore a real-time incentive-aligned expectations engine? Prediction markets provide a partial picture. They show what the broader market expects. They do not tell us how bondholders will react. They tell us how likely an outcome is perceived to be. That is a major distinction. Prediction markets offer early whispers. The long end of the yield curve delivers the thunder. So policymakers can use prediction markets to reduce surprise. If the probability of a 25 basis point cut is already high, executing that cut does not cause shock. The move is anticipated. Traders and algorithms have already repositioned. Crypto, once again, shifts from being labeled a destabilizing force to becoming a tool for measuring expectations. That does not belong in the threat column. That belongs in the indispensable column. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Bondholders, the final arbiter. Prediction markets are not the final authority. They are the early warning system. Bondholders deliver the real verdict. If inflation is sticky or rising and central banks cut rates anyway, bondholders see a policy stance that appears willing to cheapen future currency value. Their response is simple. Increase the yield. Long-term yields rise. Debt service costs increase. Governments receive a quiet reminder that monetary credibility still has a price. This creates a layered information system. Prediction markets show what policymakers are expected to do. Asset markets offer short-term opinion. Bondholders hand down the long-term judgment. And in that structure, crypto's prediction markets become policy-grade intelligence. Section 6, Miracle 4, Real-World Assets. Now let us zoom one step further out, because we are not stopping at Miracle 3. We have our eyes on Miracle 4, Real-World Assets, also known as RWAs. Tokenizing commodities, equities, sovereign bonds, real estate, art, classic cars, and essentially any asset that can be legally and economically represented on-chain. The moment we dematerialize assets into tokens, we open cross-border distribution, expand the total addressable market, and transform slow, localized assets into globally tradable, round-the-clock instruments. We do not merely financialize everything. We mobilize everything. RWAs represent the moment where the old accusation that crypto is merely speculation begins to collapse. Now the tokens represent a share of a building, a claim on a bond, a slice of real economic activity. Crypto shifts from being an alternative casino to becoming the operating system for ownership. Section 7. Token design, from yield to accumulated intrinsic value. Now let us talk about our favorite part. How do we tie all of this together without triggering regulatory resistance? The initial coin offering era followed the wrong sequence. Launch the token first, build later. The improved model for something like a prediction market is, first, build the platform, prove utility, generate real fees, demonstrate traction. Then, introduce a token as a coordination and reward layer. A prediction market token could reward traders, liquidity providers, signal generators, and integrators. It could also capture platform value through buyback and burn. Instead of dividends or yields, which regulators guard with zeal, the platform uses a portion of its fees to repurchase and destroy tokens. Instead, we get what is beautifully named accumulated intrinsic value. The token does not distribute cash. The network reinforces scarcity and value density over time. It returns value to early participants without mirroring the traditional equity model. This is not a loophole. It is a new category. Section 8. Crypto's reputation arc. Let us tie the bow on this. We have walked through central banks cutting rates into inflation, bondholders preparing their judgment, prediction markets offering early signals, and crypto quietly building indispensable tools. This is the crypto reputation arc. Bitcoin was the first miracle. It broke the monopoly on savings rails. Stablecoins were the second miracle. They upgraded the existing currency rails. Prediction markets are the third miracle. They provide policy-grade intelligence. Real-world assets are emerging as the fourth miracle. They digitize the global balance sheet. Every time critics said crypto was a scam, crypto responded with tools that solved real problems. Crypto is shifting from villain to infrastructure. Section 9. The pinpoint position. Here is the distilled thesis. Crypto's third miracle is that prediction markets have evolved into policy-grade intelligence, a real-time sentiment oracle that lets central banks, policymakers, and executives test the waters of their decisions before the bond market hands down its verdict. Bitcoin proved we could exit the old savings rails. Stablecoins proved we could upgrade the old currency rails. Prediction markets now prove we can upgrade the information rails of policy itself. And as real-world assets come online, the system that tried to block crypto will find itself running on crypto-shaped infrastructure. That is the story.